hey, look, we have a team. And compared to a financial advisor, you don't have to pay us. We'll give you the best solutions. I just need a statement. We'll tell you what we can do for you if we can help you out. Let them know too. It's like, hey, look, based on all these things, free service, we can help you. Great. But at the same time, can I ask you a question? Are you a saver or are you an investor? Thank you for joining us. We got the agent Q&A. You got your host here, John. We got Joanne.
Hi,
We got
everyone.
Albert. All right, so we got some questions. All right, so first off, we had a contracting issue a couple of days ago. If you are hiring someone, let's say you have a downline or you have a downline's downline, and they're getting contracts requested, what has been an issue if the middle downline or you don't have your agent numbers or your writing numbers updated on HTML?
Yeah. So when agents don't have their writing numbers updated in HCMS, and it's like that middle person you're talking about, they definitely create a barrier, I want to say, or like a, I don't know, like a block
holdup.
or a holdup for that other agent. And that's because in the hierarchy, the way that it's structured, everybody needs to be contracted with the carrier. And if they're not contracted with the carrier, then they need to let me know that, the current upline is not contracted and we need to skip
Yes.
them in the hierarchy.
Yeah, we need to do bypasses. So let's say we have some agents, they're from different IMOs or different companies, and they're doing FFL and they're part of something else, and they don't want to switch their carriers, but they're inviting in a downline. They don't have any carriers and they
Right.
want to get everything with us. They need to be bypassed. So let us know. But I know it's a little bit of a task issue, but once you get your contracts, go to your HTMS, add your carriers, add your writing numbers in there, because it helps us with tracking. It helps us with your future downlines as well.
Yeah. And anytime that there is somebody that is being held up, you guys will always receive an email notification from me directly from NLC or directly from HCMS, letting you guys know to go ahead and update your writing numbers.
And just one thing I wanted to add, I mean, Joanne's really good about trying to make sure everything's properly set up and not trying to skip anyone, because, we understand how you guys originally set it up to be, but we try to do everything within reason. So if there's an upline that's not responsive, they're not working, they're not doing anything. I mean, like after a certain point, if she can't get a hold of them, like we have no choice but to bypass. She'll come in and say, what should we do? And I'll just like, let's just bypass that person in the meantime. If they get contracted later, then we'll just realign the hierarchy correctly. But I mean, I think everyone needs to be reasonable about that situation too, because I had an agent when we first started. There was something, the contracting is way more complicated back then, because everything was paper and we didn't have HCMS, we didn't have Sherelle Seed that's set up as the way it is now. So then there was an agent that I hired, I put it under this agent, and then the agent wasn't using this one carrier. The downline started writing some business, and then it went on for months, and then later on, like that one agent finally like recognized he's not in the hierarchy, and then he came and he's like, dude, like I'm not in the hierarchy, blah blah blah. And I'm like, okay. And I'm like, let's get it fixed. And then he's like, dude, but think about all those overrides I missed out on.
Yeah.
And I'm like, well, I didn't know. I'm like, I'm not paying attention to every single hierarchy. I'm like, well, I'm not breaking down every single thing. I'm like, I assumed you were. And then he's like, he wasn't on top of the contract or anything. And then
Right.
he was just like, are you gonna pay me back those commissions? And I'm like, no. I'm like, first of all, I hired the person and I did you a solid. And then second of all, I'm like, if it's been months and then you don't use that carrier at all, you know nothing about it, you don't care about your business, and then and I didn't try to snake them from you. Like,
whose fault was that?
It was entirely my intention to make sure that it was supposed to be worked out, but it's your responsibility. That burden is on you. It's not on me.
Right.
So I'm like, I don't know. I mean, I don't want anyone to lose out on any overrides or whatever. So that was never my intention. But I'm like, dude, it's not reasonable.
Yeah.
Like, you should have figured that out a long time ago.
Yeah.
You should have done your follow up. And then plus, if you're not involved in your business, why do you expect to get paid on it?
Yeah. How do you watch out now when someone else caught it and then you figured out that you lost some money from it?
Right. But then also, I want to throw it back at like the managers. If you guys are hiring, then make sure that you are in position to be adding agents to your agency. If you guys know that you guys are not contracted with the carriers yet, or if you guys are pending contracting, or if you guys submitted the contracts but never followed back up with the carrier, then I think you guys definitely should take a look at your HCMS, or if you guys have any questions in regards to how to obtain your writing numbers, just reach out to us. For the most part, you guys will receive a welcome email from the carriers. If you guys don't, then you guys will yeah, if you guys don't receive a welcome email, then I would recommend reaching out to the carrier directly and seeing what the holdup is with
Yeah.
that carrier. But overall, the managers should take a look at your HCMS, make sure that your carriers are in there. And if they're not in there for whatever reason, reach out to one of us and we can definitely help you get on track before you start onboarding somebody.
Yeah, that's one of the biggest holdups that we have. We get new agents getting onboarded, but they're just invited on HCMS. And then sometimes the middle manager doesn't know how to help them with HCMS, doesn't know how to onboard them. So we get agents that are just waiting and thinking they don't have to do anything. And they don't write business because they don't have agent numbers when we can get you an agent number within 2
Yeah.
days.
Yeah. Then if you're one of those agents that's in that same situation, just reach out to your direct upline or to one of us, to me directly, and we'll for sure help you get on track with
Yeah.
having your contracting on point.
Yeah,
Yeah.
we're definitely here to help. So the thing is, if you guys get stuck in any part of the process, let us know. And the thing is, I've also had some agents be like, well, no one ever told me to do this and follow up with the carrier. No one told me to do this and blah, blah, blah. And I'm like, yeah, there's a certain level that's fair for us to try to follow up on to a certain degree. But for the most part, I mean, we're all independent contractors. We don't
Yes.
get paid for contracting anybody. So the thing is, we need some communication on your part. If you want to get it through, and reach out to us. Well, even if I'm not going to do certain parts, like I'm not going to call the carrier to follow up on your contracts.
Yeah. And you
But the thing
actually
is, I'll
can't
punch
even call the carrier for them because they don't give us any information. Like I can't call the carrier for anybody. They
Yeah.
won't give me much information on.
Well,
on
I
their
think
contracting
I can because
status.
I'm the upline.
Well, yeah.
And I got a little bit of juice.
Yeah.
There's somebody up there.
Albert.
But
Albert.
but there's certain things I'm like I'm not going to call to follow up on someone
Yeah.
else's status. Like if there's like hiccups
Yeah.
and things above your certain level of pay grade,
Yeah.
then yeah, I mean, by
We
all
can
means,
help out.
I'll take the time and do all that. But if we may just point you in the right direction, and that's everyone plays their part. Which I wanted to further expound on that. Just so if you're a manager that comes in and just says, I just want to hire a bunch of people and not do anything, get paid,
Yeah.
like that's fine. Like everyone can come in and you can play your particular role. Like we know some people say like, I just want to hire. I don't want to sell. I don't want to do anything else. I'm like, that's okay. I mean, this is if you're good at doing that, then do that. But also recognize it's not just like, I'm just going to hire people and then like completely be hands off and do nothing and expect to get paid. Because the reality is you got to understand your business up to a certain degree. Like if you don't want to sell, if you can get by financially, you're okay with where you go, that's your prerogative. But if you're just like, I'm just going to just not do anything, I'm just going to hire a bunch of people and then let everyone else do all the other work. We're going to do our part. But if you happen to get skipped on certain things, you can't cry about it later.
You're
But
right.
it's like, what do you know about your business? Like,
Yeah.
like-
There's moving parts you got to know, or somebody's got to be delegated for it.
Yeah.
So if you don't want to do anything, here's the best solution: hire some staff, somebody that knows what they're doing.
do the minimum. I'm not saying you have to do every single part of this business if that's not your goal in this industry. But the thing is, you take a little bit of pride, be a professional. Like,
It's your
figure it out.
business. It's not a business if you're not engaged or you don't have a manager, you don't have anybody. Right? So
And
doesn't work that way.
if you don't know what that is, ask one of your uplines. Ask me. I'll set you straight.
Yeah, we'll help you out. We'll be there for you. But yeah, so just make sure anybody recruiting, getting downlines, stay on track of your business, stay on track of the welcome email. That as soon as you send an invite, as soon as the agent does their HTMS, they're going to get a welcome email within about 24 hours from Joanne. And so it's on that agent or the manager to help that agent to get onboarded so they can get agent numbers so they can all make money right away.
Right.
So moving on to the next topic, conversation that happened over a couple of days. Question for Albert. We had a client, he had an orphan 401k, so he just switched to a new job. Underage, under retirement age,
Okay.
Meaning 59 and under. So he's considering then on switching his old orphan 401k to an either an annuity or just roll it over to a traditional IRA, right? So it's like, here's an agent that can help him, but what are the right things to say or to convince that client for that situation? Why annuity over traditional IRA, or why IRA over annuity?
Okay. One, an IRA is a variable product, so that's directly into the market. So there's a lot of volatility. There's ups and downs. So they can lose money. Someone's also actively managing it for them. So they're paying a fee, typically like 1 to 4% probably.
Mhm.
So those are the downsides of, putting into an IRA. Also with an IRA, there's limited contribution amounts per year that you can put into it. So there's if you have an existing lump sum of money, like a orphan 401k, which by the way, for an orphan 401k, that means you had a 401k with a company or a 403b or some other type of company sponsored plan. And then you can't roll it, you can't do anything with it until you're 59 and a half years old.
You can't touch it without getting taxed.
Without early penalty fees, unless you change employment, you retire, or you leave that company. You're no longer with that same company where you started it with. At that point, you can move it to wherever you want. And you can move it to an IRA, as we kind of discussed, or you can move it to a fixed index annuity, which is our recommendation because number one, we sell it.
Yep.
But number two, I mean, I think that there's a lot of security in it, in that there's a floor. So you're not going to lose any money on it. So you're guaranteed to not lose money. And then there's also, it creates for a lifetime income potential. With an IRA, you could lose money in the downside of the market. You're paying fees, whether you're gaining money or losing money. And then you also could you can start taking out distributions. And the thing is, all those three things in unison, at a certain point, if you just run out of money, you run out of money, right? And if you put into a fixed index annuity, the thing is, it provides you downside market protection, that you'll never worry about losing money. You can take out periodic distributions as you like. You can participate in the upsides, and then you also can create a lifetime income. So if you decide to do the lifetime income stream or annuitize it, whatever the amount is, you set it, and then it has a formula it puts it into. It'll pay you out for as long as you live. So it doesn't matter if you live to be 90, 100, 120, 150. If you live to be 200, if you're like in Wolverine,
You're right.
like that one Wolverine where you transplant your consciousness into another physical being and you lived forever, I guess the insurance company has to continue to pay you.
And it doesn't matter whether there's still money or not. You're still getting a lifetime income, right?
The insurance company is taking a bet. And if they pay you more than what you initially put into it, or paid you more than what they're anticipating pay you because you outlived that, that's just something that
They got the money for.
there's something they got the money for, because they diversify it amongst all the other policies and products that they have. So it's part of their portfolio. They factor that in.
I got a question on that. So for your 401k, even if you move it to a traditional IRA, right? So let's say he does do it in a traditional IRA. He can't touch the money without penalties. If he borrows from it or takes out from it, there's two penalties, right? One, because you're under retirement age, it's going to count against you because it's untaxed money. So that gets taxed right away. Now you got that new tax money. Let's say you took out 10,000. What's the percentage on taxes on that? About 20 to 30?
I'm not sure. You'll get an early withdrawal fee.
Right.
Yeah.
So you'll get taxed. So instead of taking 10,000, maybe let's say it's 7,000, right? Now that 7,000 adds to your income on top of what you're making. So now come income tax, you have to pay taxes on that again.
Yeah.
So if he moved it to an annuity, with annuities, you get a 10% free withdrawal. Okay. So he moves his qualified money to an annuity. Will that 10% free withdrawal be taxed as well?
It'll be taxed as ordinary income. So it'll be taxed on
just one time
total
at the end.
Right.
But he won't get a penalty for taking it out. Right. So that's the benefit of an annuity, where if you need some money, you can get a 10% free withdrawal from it, and you're not going to get taxed twice.
Yeah, but more importantly, the thing is, if you cash out an IRA, you're gonna get taxed on it. If you do a simple rollover, and this is probably a lot of clients' concern, you do a simple rollover from a orphan 401k or an IRA, whatever, and you roll into an annuity, it stays tax deferred. There's no tax implications.
Right. And then let's just expand on what is an IRA. All of these are actually IRAs. Okay. IRA just stands for individual retirement account. So you had an individual 401k. If you move it to your traditional IRA, your own independent retirement account, or the annuity, it's still also an IRA. Right? So a lot of clients forget that, or they think they reclassify what's what and what's this and what's that. They're all your retirement vehicles. So when you roll it over, it's going to be the same thing. So it's beneficial. We learned it from Coronado in the sales conference last week, or two and a half weeks ago, maybe now.
Real good training.
Yeah. So he used an analogy of going to the mall. Okay. So when you go to the mall, there's the elevators and there's the escalators. So the stocks, the bonds, the market, he calls it the elevator. It can go up and it can go down on levels. When you move it to an annuity, it's like an escalator. It can only go up and go up and go up. It doesn't go down with that one escalator. So if the market tanks, elevator will go up and down, the escalator will just stay still. And then when the market makes money again, the escalator goes back up. So that's the benefit of an annuity. When you get into a client in that age group, you know, if they're in their early 30s, early 20s, okay, maybe they have a flexibility, they have a chance in the market, they have the ability to recover their losses if the market tanks. But if they're nearing retirement, would it be safer to go on a traditional IRA versus an annuity? I would think about getting to an annuity instead of being aggressive with making more money. I would be more conservative because what are we doing right now with the market, right? Market's not exactly being great. Hopefully it's going to recover, but at the same time, when will that happen again? When will it go up and down? So that would be my take on moving that to an annuity.
Well, yeah, I want to, in full disclosure, I just want to make the point that an annuity is not for everybody. So like the thing is, depends on your risk tolerance,
Right.
and depends on how aggressive you want to be in the market in terms of investing. So like you're like a crypto maniac,
Yeah.
and you just like, you love the upside of crypto, or if you want to play the markets and you just think you're like the Wall Street genius and you're a Wall Street whiz and you want to take your shot at it, like there's much more potential upside for that, because with an annuity, the way they credit you interest is how you gain money in it.
Mhm.
Is that you're going to the insurance company, they track along with an index, and then when that index does well, they'll credit you a percentage of it, not the full amount.
Right. They
You know,
take their cut.
They take their cut first, so that's their VIG.
Yeah.
So it's like the dealer. They just take their percentage first, and then you get the rest of it, which it's actually a good risk, because the thing is you have downside market protection. So
Right.
the thing is, if the market ever goes down, index goes down, the company eats the loss alone.
Yeah.
The insurance company eats the cost alone, and then you like the escalator situation, like you'll go up when you have interest credited. If there's a down year or a level year, you just stay flat at what you're at. So you're not going to lose anything beyond what you currently have.
Right. So you have a floor. And more importantly, let's say this client gets a new job. Guess what? Maybe the new job will also offer a 401k.
Yeah.
So I would recommend, well, build that new 401k and diversify your assets. Now you got a 401k that's marketing and working with the stock market. Now let's take this orphan 401k and let's conserve this. Make it a conservative investment account. So now you're diversified. So if the market tanks, this one will go down, this one stays still. If the market goes well, now both goes up.
Yep.
Can't lose.
Right. And you know, I help a lot of agents with annuities. So I think sometimes people look at it very binary. They're like, why wouldn't everyone just want to get an annuity? Why would anyone be so stupid to keep it in a 401k or what? I'm like, well, you know, they're getting a company contribution match,
Mhm.
right?
Matching.
Why wouldn't you do that? And then you have a lower tax footprint, and you don't have to move everything immediately. So if it's even eligible to move. So, you know, there's got to be there's got to be right situation. So this is why it's important for us to ask the clients the right questions, you know, make sure we ascertain the information that we need to help them make a decision that's in their best interest.
Mhm.
So, you know, I love what an annuity can do. And I think it's very underutilized and not enough people know about it. So, I mean, I think it's important for us to have this discussion to share more information about it, so people can kind of look into it to see if it's a right product for them. But, you know, I think in certain situations, you know, sometimes maybe it's not the right situation. And if the client tells us enough, if we gather enough data and we're like, okay, well, it's not really what you're looking for. We gave it a shot. We did our best. You know, maybe you're better off somewhere else.
And then you're going to learn that experience. You're going to learn that through multiple variables, multiple clientele of like who you're dealing with. And that's when you're going to find out if an annuity is the right product for that individual.
Right.
But knowing more about it, learning more about it, you know, watching the videos. If you guys haven't been, go to fflams.com. You'll learn more about the simple retirement solutions of annuities, because these are the knowledge you're going to have once you build this up. Now you can really talk to an individual. If it's like a technical thing, you know, it's above your pay grade, and now you're going to get to that pay grade because you're learning more about the annuities. Because sometimes, you know, we do make money off of it, right? We make a sale off of annuity, and now you're just pushing the annuity without really catering to the client. Now they kind of see the dollars in your face, the dollars in your eyes, and saying, are you here to help me, or are you here to make money off of me?
Well, going back to your original example, I mean, I guess if an agent runs into that type of situation and you don't know what to say, you don't know even how to really broach the topic, just be like, if you find out that they have an existing 401k or they have a lump sum of money that they don't know what to do with, that they want to put towards their retirement, just be like, okay, you know, actually, can I ask you a few questions about that? And just be like, how's that performing for you? What's your long-term goals with the with the money? Like, are you looking to retire anytime soon? Like real basic questions.
Mhm.
And if you don't know anything, which is perfectly fine, because we're all at that point at some point, you can just say, all right, if you want to grab a copy of that statement, actually what I'll do is I'll bring it back to my safe money retirement department
Mhm.
or the simple retirement solutions department or whatever you want to call it, something non-threatening.
Right.
And then just be like, I can't do it right now because I do have other members I need to go and meet with. But if you want to go and grab that statement, I'll bring it back to my one of the experts. They'll
Right.
get a chance to look at it. I'll let them know your details and your situation, and then we'll put together some illustrations to see how that's going to work for you. And we compare it side by side with what you currently have and what we're able to potentially offer you. And if it makes sense to you, then we'll see if we can help you get approved for that.
Yeah.
So, will next week work for you, or in a couple of days work for you, and then bring it back to one of us or to the SRS department or AMS department, however they want to brand it now.
Yeah. Yeah.
And then get the help, and then we'll take it from there. So I'll walk you through the rest of the process if you're worried about, I don't know what to say from there. So just keep it simple.
Yeah. To be the simplest part is, I think, instead of you selling the product in front of the client and you're smashing them about the annuity, the benefits of annuity, take it in a slow sales approach of saying like, hey, look, we have a team. And compared to a financial advisor, you don't have to pay us. We'll give you the best solutions. I just need a statement. We'll tell you what we can do for you if we can help you out. And then more importantly, you let them know too, is like, hey, look, based on all these things, free service, we can help you, great. But at the same time, can I ask you a question? Are you a saver or you're an investor? So ask these little questions to just figure out what they're leaning towards, right? And that's it. Open up a little spark of interest. Maybe you bring value to me. Right. All right, well, give me a statement.
Well,
help you out.
That's actually a really good question. If you want to see if like they're like they rather go and invest it, or they want to like put into something like this, you'll see what the risk tolerance is, because you ask the question, are you a saver or are you an investor? Most wise acres will probably just say, oh yeah, I'm an investor.
Yeah.
And then you're like, okay, so you're okay with losing money?
Yeah.
Okay,
What's your percentage of loss? Risk tolerance.
And then they'll be like, oh, I don't want to lose any money. Then in reality, you're not an investor. You're a saver that wants some of the investment upside.
Right.
So that's what an FIA can do. And that's the main difference. So it's important that you learn how to ask questions like John just asked.
Yeah. So for you guys that are brand new, just don't slam the clients on, this is what you got to get. Let me help you out. Let's just try to take it one step at a time. What do you want to do? You want to save? You want to retire? You want to compound it? Let me know. I can help you out. By the way, it's a free service. We have experts. We have departments. They got all the licenses to analyze your situation. And then let's see what we can do for you. So for new agents, we have this thing called a fam bam, right? Just from a meeting, book an appointment from a meeting to another meeting and get a statement, set up a time, and then make it a real appointment instead of just like, hey, I just met you. Let's go sell you some annuities.
Say fam bam or bam fam?
Is it bam fam or fam
bam?
Bam fam.
Bam
Bam
bam.
fam. Bam fam.
Book a meeting from a meeting. Book a meeting from a meeting. I mean, fam bam is like another cool term, I guess.
It's a better term, right? Fam bam instead of bam fam.
Which by the way, one time we were watching a training with Andrew Taylor.
Yeah.
And then he said, book an appointment from an appointment. And he's going over annuities, and he's talking about book a meeting from a meeting. He's like, book an appointment from an appointment. And I was like, isn't that bafa?
Whatever, however it makes it easy for you guys, we got your back. So on follow-up to that, okay, so these are great things, right? When we make an annuity sale, we make good money, right? We get a big percentage off of that. And when we make an IUL sales, it's typically a big AP too. Yeah. So how do we get more of this? So if the real question is, so if you're marketing these products, whether it's an IUL or annuity, to your clients or for a client through your social media, who should be your target demographics? Who should we look out for, or attract?
Well, you found a couple by happenstance, right?
Yeah. But wait, what was your question again?
So how do you find a client? How do you find clients if you're social media, or who's your target demographic?
Who do you want to market to? Who do you want to prospect from?
For IULs and annuities.
Oh, for IULs and annuities, who would I market to?
Yeah.
Well, because you had your experience. So that's what Albert was saying. Talk about like the doctor, the dentist you were talking.
Oh, yeah. So because you guys are saying social media, but I think
I think marketing and prospecting is very, very wide.
Yeah. I think like when it comes down to annuities and IULs, I want to say like for annuities, I would kind of market more towards honestly, like healthcare individuals. I think most of them definitely have retirement plans.
Yes.
Also, educators would be another good one. Um, I don't know, what else would you?
Yeah, those are good. Like middle earning
Yeah.
to high earning clients.
Yeah, I would just say like going towards anybody that would basically like bigger corporations or bigger industries that for sure hold and lock down people for 20 to 30 years,
Union members, huh? Union members are
Yeah.
good. Yeah. Yeah.
So,
Targeted like areas that are, I wouldn't say affluent, but they're middle income to high income earners.
yeah.
But in their industry, they have zero knowledge in the financial industry, right? So nurses are good, right?
Yeah.
Nurses,
great.
they're really great at their healthcare field, but when it comes down to money, they just know how to spend it.
Yeah.
And they're like, tell me what to do. They're in that category where do they want to pay for a financial advisor, or they're not at that higher income about it yet, right? So great thing for IULs, teachers, like you were mentioning, public employees, they have great benefits, especially here in California. They have CalSTRS and CalPERS. But if you understand about their retirement, they don't get their full retirement from there. They usually get like 60 to 80%, 90% if you did a lot of years and a lot of your age and your
tenure.
years, right? Your tenure, it's still not going to be 100% of their income. So that's where additional IUL can help out. Even better too, a lot of people that are self-employed. Okay, so great people. If you guys Uber,
Yeah.
drive, if they're doing this for full time, barbers,
people in the weed business.
yeah, bartenders,
seriously.
Yeah.
barbers, bartenders, they make good money, but they're like self-employed.
Yeah. A lot of small business owners.
Small business owners, tattoo shops, hairstylists. Yeah.
You know who else gets a lot of IULs? Super wealthy people, right?
Yeah.
Because it's a non-reportable tax-free income that you can generate on the side, right? You can generate. It's tied in with an insurance product.
Yes.
So number one, if they have that much money, they probably have that insurance need anyway. Even if they're loaded.
Yeah.
The thing is, they still need to transfer wealth over. When they pass away. So there's got to take care of the state taxes, all the wealth transfer process. So they'll need some insurance anyway.
Mhm.
So they'll need some life insurance, and then on top of that, they're able to create that extra supplemental retirement income. A lot of high net worth individuals, the whole infinite banking concept, they'll be your own bank thing, which I think is a little bit overplayed because it doesn't fit every situation. Definitely doesn't fit like lower income people that really want to be their own bank. And I'm like, bro, you don't have a bank account. So
I want to be my own bank. With your chime?
I know it's like let me tell you, $30 a month ain't gonna cut it for an IUL, or it's not gonna do what you can get a policy for whatever amount, but the thing is, it's not gonna serve the purpose that you originally had intended. If you're looking at, so there's a dichotomy between how much you're able to get covered in that situation.
Yeah.
But a lot of high net worth individuals, they decide to take out another life insurance policy because they recognize the tax benefits of it. They can go and invest the same amount of money in a stock or into mutual funds or into whatever riskier portfolios that they want to put their money into.
Yeah.
Or they can get an insurance policy and then track along with the index. They have the life insurance built in with it. And then when they're able to access that cash value later on, that builds up, accumulates over time with compounding interest and all that good stuff. With the access to that money, it's tax free.
Yeah, there's even crazier stuff for the super high wealth individuals. We used to have an agent that was doing that. They had ways to use an IUL to save them tax. And then for the super millionaires, man, they know the tax codes and tax brackets where they would get even a foundation involved, right? So you would donate to this foundation. The foundation's the beneficiary for the insurance policy, but the foundation's yours. It's under your name in a separate tax code, but also the foundation is the one that threw a lump sum of money into the cash value to build it up, and it's all like circling around from each other. And yeah, they save some taxes, they save some money, and the foundation gets paid life insurance when the person dies. It's crazy.
Disclaimer: this is not financial or tax advice. We're just talking about some of the things that people can do.
Yeah, it's crazy.
And IUL is such a tremendous tool if people understand how to use it. So if people come across a situation where they're like, hey, I have this amount of money, or this is my income, or whatever, we can present these options to them and kind of walk them through certain scenarios.
Yeah, I think it was called like premium financing or something.
Premium loan financing.
Yeah.
Yeah.
I think it's wild.
Yeah. People would pay that, and then they'd be able to spend their money and then just leave the death benefit for their family instead, right?
Yeah.
So there's a lot of different things you can do with it.
Yeah. So the higher the levels, we have a plan, and just understand we have our people. We have our SRS team, our FFL AMS, our advanced market team that can help you out with that. Last part, there's also that key person insurance for the business owners. So basically with the key person insurance, their business pays for that policy. They could set it up for their CEO, their employee, no benefits, but it'll be a life insurance. The beneficiary is the business, but they can take it away as a pension with the cash value as a lifetime income draw later on in the future once they do retire 20, 30 years down the road. So a lot of options available for our clients. So going back to the first question, who's the demographic? Any other persons or people that you have in mind?
Yeah, I think everyone can use one. I just think for people that are lower income that can't commit that much money, it's counterproductive to get an IUL because you can't really overfund it. So you're paying barely the minimum and probably missing the minimum at certain points.
Yeah.
And if you're doing that, then the thing is the cash value never really gets an opportunity to accumulate to the degree in which the purported value actually matches to what that client wanted. Right. So you're missing out on that altogether. So it's for a client that is responsible for their money, that is able to overfund it properly, and they understand what their long-term goals are.
Yeah. So in that end, my suggestion would be for those clients, with the IOL, there's your cost of insurance, then the overfunding of it. The best solution then is to overfund on a young kid. Okay. Do it to their children. So it might not make sense for them because it's not going to be enough, but you can start a 1-year-old to a 5-year-old, $50, $100 plans, and they'll be good.
Which, I mean, I guess I should bring this from my own practical experience. So I'll get some leads sometimes, and then people are like, I'm like, so what's your main goal here? They're like, I want to be my own bank, or I want to build up a retirement income, and they're in like their 50s or 60s.
Right.
And then I'm like, so what's your budget for this? Which it's really not that practical. So there needs two things really for the cash value to accumulate to the degree in which it has real significant value to the client. It's number one, you need to be able to overfund it, be able to have enough premium to put into that. Because the three basic parts is for a premium for an IUL, the first part is like the fees, the administrative fees, or you call them cleaner fees,
janitor fees.
So that's for the company to pay their bills, to pay for the insurance agent's commission, keep the lights on, to process the applications, all that good stuff. The second part goes into the cost of insurance,
risk,
which when you're younger, when you're younger, it's cheaper. And then as they get older, that cost of insurance will continue to gradually increase.
Yep. And
then less of that premium goes into the cash value accumulation. So the remaining balance out of that premium goes into the cash value accumulation, which for a guy like Bryce, it's when you're younger, your premium doesn't have to be that high because more of that's being apportioned out of that premium. The bigger third is going to be a portion towards the cash value accumulation. And then you have time. You have the luxury of time when you're younger.
Compounding.
So it starts compounding over time. If you're an older person, like you're in your 50s and 60s, which is not old, but in terms of insurance, it's not the most practical thing to get an IUL unless you're able to really overfund it. And even then, your cost of insurance is higher, so less of that premium is going towards the cash value accumulation anyway. So, certain situations I'll run to clients and they'll be like, I want to be my own bank, I want to do all this stuff. They may be in their 50s or even late 40s. And then I'll be like, okay, so what's your budget? They're like, I don't know, like $100. and I'm like, I'm just gonna be honest with you. It's a little counterproductive to do at this point. And I run through that same explanation I just went over. And I'm like, but what we can do, if you're healthy enough, we can do a policy. And I do my Americo CBO 100.
Nice.
I'll say you're gonna be covered for this amount of money for the next, 15, 20, 30 years. And if you don't die, you get all of your money back. And it's like they which for the majority of them, they're all like, okay, cool. That sounds good. Cause they've never even heard of that product before. Yeah. They also didn't know that an IUL may not fit their particular situation. So the thing is, I'm trying to give the client what they ask for. But then again, like if I, as an agent, as a professional, because I care about my craft and I'm just trying to understand the products and situations. If there's a situation that doesn't fit for them, I'll let them know, hey, maybe it's not going to work like you intended it to work based off of these factors. And I explain to them, you want to go this other route instead.
Yeah, especially that CBO, you can set it up within 15, 20, 25, 30 years. The CBO is set up where you have the life insurance and enough cash value to get all your money back based on the premiums you paid. So it's a pretty high accumulating product, and it's like guaranteed.
That's a guaranteed universal life, by the way. So the Americo product when it comes to HMS, which is Home Mortgage Series, for those that wonder what it stands for, you don't have to necessarily have a mortgage to get the product, but for the term 100, it's obviously it's just straight term, covers you for the next 20, 30 years, whatever you choose. The CBO is a cashback option. When you do that, it's no longer a term, it becomes a guaranteed universal life policy.
Right.
So it's a GUL, and that's how you're guaranteed to receive all your money back, unless you start pulling from the cash value.
You borrow from it,
Yeah,
or
you borrow from it.
Automatic loan.
It won't be the full amount. You just be taken out of the.
But yeah, that's a better
ultimate.
solution, because you can set it up where if these people want to be their own bank and they don't have the years to compound, you can set them up on a 15-year. They get all their money back. It's a bigger amount than the compounding a cash value IUL will do.
Right. Yeah, and I think that's the thing I've learned over the years. Like, yeah, we're all trying to do right by our clients, and sometimes we want to be too much of a people pleaser.
Yep.
In certain situations, you just got to be practical. You got to be the professional here and just be like, it's not going to work, and here's why.
Yeah, it doesn't make
sense. Here's my suggestion. If they still say, I don't care, I still want to go with the IUL, like, I'll happily sell it to you, but you're going to be disappointed later.
Right. I remember from Sean Ruggiero that was teaching about FFL AMS. He talked about the years and the compounding and how much would a good IUL be. He said in your 30s, you should be doing like 1,000 a month. And then in your 40s, like 1,500 to 2,000. In your 20s, you can get away with 500-ish. So when you got a client saying, I want to do 100 a month in their 50s, it's not going to do a lot.
I actually heard a really good rule from one of my clients, because like he did his research about being his own bank. He ended up not getting it because I went through the progression with him, and he recognized it wasn't the best thing. Yeah, because I ran through a couple illustrations, and he was like, "Yeah, it's not really
enough at the end, huh?"
Yeah, he didn't have enough time. So, but I was like, I just try to feel him out at the beginning. So I was like, all right, so why do you want this product? What do you want it to do for you? And I'm like, now if we find a product that actually works for you, what's your budget for this? And then he was like, and I actually learned this from him. He was like, well, I was reading a little bit online, and then I heard a good rule is whatever your age is, put a 0 behind it. So I was like, that's actually not a bad rule for younger ages.
So if I'm 37, put 370. Okay.
That's good minimum, right?
Yeah. Yes. You get the same thing with clients. And then we're going to wrap it up with this because we're about to run out of time. You get a lot of clients. Yeah, I want to set up something for my kid. I want to set up for their college. And then they're like, what's your budget? $50 a month. What kind of college education are you getting out of that?
Community college?
Some books? Or they tell you this, and like, I want to set up for something for my retirement. How much is your budget? $30 a month? Come on, man. You're not going to retire with this. You're not going to send anybody with college to this. So before you even do a product, sometimes it's easier to just slap them right in the face like, bro, that's not saving. Right. That's not getting you anywhere. So any other last thoughts? Any questions for us before we wrap up? Hopefully this helped you guys out. This is going to be saved on YouTube. Feel free to like and subscribe. It's going to be on FFL Elite Clips. So it should be up and running by Friday. So we'll see you guys then next week.
Appreciate you.
Bye,
guys.
everyone.
Have a good one.